If you're looking for a risk-free investment that beats inflation in the US, then this is the video for you. And as it happens to be a bond investment, we'll cover the basics of bonds too. The US markets are highly volatile right now, and so are markets around the world. There are the inflation worries, the Fed interest rate hikes are imminent, and then there are the midterm elections to be concerned about. The question on your mind as an investor is, where do I put my money right now so that 1, I don't lose the principal, and 2, I also get a reasonable return so that amidst the high inflation, I'm at least able to retain the purchasing power of the money. Before we discuss this special bond investment, which is risk-free and also beats inflation, we need to discuss the basics of bonds first. To understand the concept of bonds, let's compare it with something that we already know. A deposit account, such as a savings account. When you put some money in a savings account, what the banks do is that they offer you a small interest and then they take the money and lend it to other corporates and governments at a much higher rate of interest. And the difference is what is known as a spread. And that's how the banks make their money. So the question that immediately comes to your mind is, why should I take such a small interest and let the banks have a larger share of the pie? Why can't I lend directly to the corporates and the governments? Is that possible? Of course you can do that. And whenever corporates and governments need to raise money for their projects, they can reach out to the banks, of course, but they can alternately reach out directly to the investors. And they do so by issuing what are called bonds. And when you buy those bonds, you are lending money directly to these institutions in return for an interest payment that they pay to you semi-annually. Since you're lending money in return for a fixed stream of income, these are also called debt instruments or fixed income instruments. Bonds would make sense only when your motivations are capital preservation and a steady stream of income. You're not going to be making a killing with bonds, but you're not going to lose your principal either. There are 3 types of bonds based on who you're lending your money to. If you're lending directly to the US government, then these are called treasuries. These are further classified as bills, notes, and bonds based on the term of the loan. Bills have a maturity of a few days to 1 year. Notes have a maturity of 1 to 10 years. And bonds have a maturity of 10 to 30 years. The US treasuries are the least risky because you don't expect the US government to default on its debt. Then you have the municipal bonds where you're lending to the states, cities, counties, and other government institutions. These are slightly more risky than the US treasuries. Lastly, you have the corporate bonds where you're lending to the private and the public corporations, which have varying levels of risk. To round up our understanding of bonds, let's look at 3 metrics which can be used to assess bonds. The first metric you need to be aware of is bond rating. This measures the credit risk or the ability of the borrower to pay the principal and the interest. These are issued by rating agencies such as Moody's and Standard & Poor's. For example, a AAA rating indicates an investment-grade bond which has the lowest risk, whereas a B rating indicates a junk bond with high risk. The next metric that you need to be aware of is bond yield. To understand bond yield, you need to understand some related terminology. In the bond that you see in the picture, the loan amount is $100, and that's the face value of the bond. And at the bottom of the bond paper, you see what looks like stamps or coupons. And that's what they were called, bond coupons. And when the holder of the bond takes these coupons to the issuer, he can redeem these coupons for the amount that's mentioned on the bond coupon, which is $4. And that's the coupon payment. And the rate at which that interest is paid out, in this case, it is $4 semi-annually. So $8 annually for $100. So the 8% rate was known as the coupon rate. Today, all this is done electronically, and if you buy a bond for, say, 10 years and you held it till maturity, then you'll be collecting all the coupon payments electronically, and at the end of the 10-year period, you'll be paid back the loan amount or the face value. In this case, all you needed to know was the face value and the coupon rate. But if you decided to sell the bond before its maturity, say in the 5th year, then the price you're able to sell your bond for depends on the interest rate prevailing at that point of time and how it compares with the coupon rate on your bond. If the prevailing interest rate is more than the coupon rate at the time you want to sell your bond, then there is no motivation for any buyer to buy your particular bond, and they would rather buy the newly issued bonds in the market. So what can you do to incentivize them? You cannot change the coupon payment because that's fixed for a given bond. But you can offer your bond at a price which is lower than the face value, and you will be offering it at a discount in that case. If you're selling your bond at face value, then your return on the bond is equal to the coupon rate. But if you're selling it at a discount, that is at a price lesser than the face value, then your return or the bond yield is calculated as coupon payment by the price of the bond. And bond yields, along with bond ratings that we saw earlier, are sufficient to make a buy decision on most bonds. But since we are in an inflationary environment, we need a third metric called bond duration. And bond duration measures the price sensitivity of bond to interest rate changes. As you know, when inflation changes, increases or decreases, the interest rates would be changed by central banks, and that will impact the bond price. And if you're buying bonds, you need to be able to judge how the price of your bond will change in response to the interest rate and inflation and affect your eventual yields. But this is a little complicated. It is complex mathematics and we want to avoid it. That is why we want to have a bond whose coupon payment ideally changes in tune with inflation and interest rate changes, so that we don't have to get into bond duration, its calculation, and all those complex math. We have two such bonds where the coupon payment automatically adjusts with inflation. And these are Treasury Inflation Protected Securities, or TIPS, and I bonds. Both are issued by the US Treasury, so they are literally risk-free, and you don't have to worry about bond ratings. Now, let's look at a comparison of TIPS versus I bonds. How do they work? First, TIPS. The principal is adjusted based on the consumer price index, which is taken as the proxy for inflation. The interest rate is fixed, but since the principal gets adjusted at regular intervals, when it's multiplied by a fixed interest rate, you get a varying interest, which is the varying coupon payment that we wanted, that varies with inflation. You have 5, 10, and 30-year term TIPS, and you can buy them at treasurydirect.gov. The other alternative way of purchasing them is through TIPS, ETFs, and mutual funds. You can invest anywhere between $100 to $5 million. And if you're selling pre-term, you have to transfer the securities from treasurydirect.gov to your bank or brokerage to complete the transaction. With I bonds, the principal stays the same, unlike TIPS. On the other hand, the interest rate, which has two components, a fixed and a variable rate, gets adjusted based on the CPI. If you go to the Treasury Direct website, you will land on this page eventually, Series I Savings Bonds Rates and Terms, if you look hard enough. They have a very interesting table on how they use the fixed rate, which is currently 0.0% for the period November 2021 to April 2022, and the semi-annual inflation rate, which is taken as 3.56% based on CPI, to arrive at the composite rate of 7.12%. There is a formula that is explained here if you're interested. Then the page goes on to show some other interesting tables, one of which is for the November 2021 to April 2022 period, what are the interest rates that you could earn on I bonds purchased previously. If you go to the bottom of the table, you see that I bonds purchased around the October 1998 timeframe are earning 10.64% during this period. That's a pretty fantastic rate of interest. The term of the I bonds is a 30-year term only, and you can buy them at treasurydirect.gov or through your tax refunds. The investment range is anywhere from $25 to $10,000 if bought through treasurydirect.gov. And if you're also using tax refunds, then you can purchase an additional of $5,000, not in electronic form, only in paper form for those $5,000. And this is per person. So if you have multiple members in the family, you can buy more of these I bonds. Again, if selling pre-term, you have to transfer to the bank or the brokerage. Now, bond yields for TIPS, it is 0.5 to 1.5% less than the rate of inflation. You cannot beat inflation, but you get pretty close to it. Now, I bonds, you have the fantastic 7.2% return that we just saw. The pros for TIPS, deflation protection, but only if held till maturity. If you try to sell in between, then you might have a loss of principal. There is only federal government tax, no state tax or local taxes. Can buy and sell anytime. With I bonds, there is deflation protection at all times. This is because the principal stays the same and the interest rate can never be zero. So the principal cannot go below the amount that you initially invested. There is again only federal tax, no state taxes, and the taxes can additionally be deferred. And one more advantage is it can be tax exempt. That is, the proceeds can be tax exempt if used for eligible education expenses within the same year. The cons with TIPS is that the principal gains and the interest gains are taxed annually. Particularly the principal gains, while you cannot withdraw any of it during a given tax year, it is considered as phantom gains by the IRS and taxed annually. Then there is the possibility of capital loss, like I mentioned earlier, if not held until maturity. With I-bonds, since there is no active secondary market, you can only sell it back to the government, and the government will not allow you to do it during the first year. And if you're selling within the first 5 years, there is a 3-month interest penalty. So I think it's safe to conclude that if you can afford to keep your investment locked in for at least a year, and if you're not going to be investing more than $10,000 per individual, then I-bonds seem to be a pretty good bet. So to summarize, there are 3 things that we discussed in the video today. 1, bonds are good for capital preservation and for generating a steady stream of income. 2, whenever you're evaluating bonds, you want to look at bond ratings, bond yields, and also bond duration. And lastly, in the prevailing inflationary environment, I-bonds seems to be a good option. In my next video, I will be discussing the basics of stocks. If you watched the video so far, please hit like and subscribe to the channel. This is Senthil with the Game of Money, discussing investing, business, and careers.